Guten Morgen, meine Damen
Good
und
morning,
Herren.
ladies and gentlemen. A warm welcome to ZF's annual press conference 2025. Another challenging year lies behind our industry and behind ZF. A year in which we made numerous strategic decisions despite all the current issues. Today, we will provide you with an overview of the business performance in 2024 and share our outlook for 2025. This will be presented to you by ZF CEO Dr. Holger Klein and CFO Michael Frick. The presentation slides are in English. The presentation itself will be in German. After the presentations, you will have the opportunity to ask questions directly here in the Teams conference. You are also welcome to use the chat function for this. In the English channel, this is the only option available due to technical reasons. I now invite Dr. Klein to give his presentation.
Guten Morgen.
Good
Herzlich
morning.
willkommen zu
Welcome
unserer
to our annual press
Bilanzpressekonferenz.
conference. Thank you for taking the time. Many of you have been with us for years, and particularly intensively for several months. I can well understand that the ZF topics are met with great interest because they trigger emotions. That's why I would like to not only inform you today about fiscal year 2024, together with my colleague Michael Frick. I would also like to explain to you firsthand our strategy of strengthening our strengths, unlocking our potential. Before we begin, allow me to share a brief personal perspective. When we talk about the environment in which we are operating and what ZF requires, the term transformation alone does not fully capture the scope. Our industry has never been so clearly in the midst of the perfect storm. We are witnessing weak markets, structural deficits, bureaucratic burdens, and significant cost increases. We see uncertainty about technological developments, especially in electric mobility, erratic industrial policies, market isolation, state-sponsored competitors, and sharply rising capital costs. It's not the individual factors that force us to change as comprehensively as never before. It's the sum of all these factors. Because these factors impact us daily, we must act decisively. This is clear to everyone, our shareholders, our employees and their representatives, and our entire environment. We have no other option than to shake the foundations of ZF, to thoroughly examine this great company, and to find out together what the path to a good and promising future is. After all, we want to continue to offer attractive technologies and maximum innovative strength in order to be a central and reliable partner for our customers. We are fully aware that this involves great efforts and that we are demanding a lot from our employees. This does not leave us in the board unaffected, as ultimately all our decisions always impact the people who work with us. In short, what is often referred to as transformation is actually a profound renewal. It follows the clear goal of leading ZF back to where it belongs, at the front. This is like an open heart surgery, as we must ensure every day that our business runs smoothly and we are there for our customers, which, by the way, we are managing quite well, as you will see later. Ladies and gentlemen, we dedicate ourselves fully to our goals every day. This requires intensive discussions with employee representatives who strongly advocate for the workforce's interests, while recognizing at the same time that things cannot remain as they were. It is crucial to find common solutions and make compromises, a fundamental aspect of our social partnership. I have to admit that this process is often challenging, but successful, and it's worthwhile. Here I would like to thank the employee representatives. Now let's look back at the past year. 2024 was challenging. The automotive industry is undergoing a fundamental transformation driven by competition, cost adjustments, and geopolitical changes. The adoption of electric mobility is slower than originally expected. Our customers are rolling out savings programs. Additionally, the German economic model, with its strong export orientation, is particularly vulnerable when protectionist tendencies spread. This is also one of the reasons why Germany is falling behind in economic growth in Europe. Production volumes in Europe remain clearly below the peak of 2017, with a structural shift in the passenger car segment and a cyclical downturn in the commercial vehicle segment. A thorough recovery is not in sight, which is why we are adjusting our capacities to the lower level. Here a quick note on the Chinese market. Unlike Europe, it has grown by around 4%, with Chinese brands leading the way. We as ZF are continuously expanding our business with Chinese manufacturers, but our revenue share needs to grow further to fully participate in this growth. At the same time, new products are being launched across all areas. This means that, in addition to structural issues, we are also facing a multitude of new launches. This requires high investments and demands a lot from our workforce. But we are successful because we act as a team with incredibly dedicated people working at ZF, and they are our face to the customer. Therefore, I sincerely thank all employees who, even in challenging times, give their best for ZF every day. How do we respond to these challenges? With a clear strategic roadmap. We call it Strengthening Our Strengths, Unlocking Our Potential. ZF with its current structure is the result of an era when size and a broad portfolio were the strategic paradigm. We expanded through acquisitions to create synergies between the business segments and to offer our customers system solutions across all areas. However, due to the transformation of the industry and ongoing market weakness, this strategy is no longer viable. We've built up inefficiencies and excessive overhead costs, and our debt prevents us from being able to invest in all areas simultaneously. Therefore, after I started as CEO in January 2023, we established a clear plan based on 3 areas of activity to guide us towards a new target picture. Our goals are to further reduce ZF's debt, strengthen our resilience in the long run, become more competitive and more agile. These 3 areas of activity are, firstly, performance and competitiveness. Here we are working to increase our productivity, to improve our financial results, and make the company successful again. Secondly, portfolio. We are reviewing our technology and product portfolio to determine what we want to develop further ourselves and where partnerships might be the better approach. Thirdly, structure and culture. This involves measures to change our structure so we can provide the different divisions and business units with more entrepreneurial leeway. This allows for a more targeted focus on specific customer requirements. Therefore, we speak of a cultural change as this leeway requires a different mindset from our employees and executive managers. Let me start with the performance measures. Already in 2023, we launched 3 performance programs. 1 for the passenger car business, 1 for the commercial vehicle business, and a 3rd program to strengthen the competitiveness and productivity of our German locations. In addition, we are reducing our overhead costs and adjusting our workforce to the changed circumstances. This includes reviewing our location structure and aiming to reduce between 11,000 and 14,000 jobs in Germany by the end of 2028 in a socially responsible manner wherever possible. We are in a constant dialogue with employee representatives and have agreed on a joint approach with them. We have already made good progress here. Through natural turnover, retirement, the expiry of temporary contracts, and by collectively reducing weekly working hours, we've reduced personnel capacity in Germany last year in the scope of around 4,000 jobs. We have faced harsh criticism for these reduction targets, and I take this criticism very seriously, as it reflects our employees' legitimate concerns about their jobs and their future. Therefore, it's important to us to ensure ZF's long-term competitiveness while fulfilling our responsibilities as an employer. We are committed to securing as many jobs as possible and making any necessary job reductions in a socially responsible manner where possible. We are on track with our performance programs. They are already delivering significant positive results that will continue into the future and provide a foundation for further progress. Although we've been able to significantly adjust our operational cost structures and successfully renegotiate customer prices, we've even exceeded our original savings targets. However, economic developments and one-time effects have negated and even overcompensated some of the improvements. As you can see from the chart, the measures implemented in 2024 will also recur in 2025 and even increase. When the market recovers and one-time effects disappear, we will sustainably benefit from increased profitability. You can see that we are in a transition year where the results of our work will only gradually become visible. In addition to the measures to improve performance, I would like to now explain the measures and successes in the portfolio. We have strengths in our portfolio that we want to enhance. These are the dark blue areas, where we are currently ranked number 1 to 3 in the market. Then we have business areas that have clear synergies with our core business, but the potential of which we want to develop with partners. These are the light blue fields with the goal of being among the top 3. And there are areas, the grey fields on the right, that are very successful but have low synergies and for which we are not the ideal owner. This is because we may not invest enough or focus sufficiently on the business, as it is not part of our core. In these areas, a partnership can be a suitable measure that benefits the business and helps us reduce our debt. The passive safety systems division is an example of this. As the business is intact, but has few synergies with our core business. Therefore, we've now established the division independently and successfully in the market under the name ZF LifeTech. This opens up additional business opportunities for ZF LifeTech. This independent setup is already showing success, but we are open to a buyer or even an IPO if the right market window arises. We are not acting under pressure here, but will proceed only if the conditions are right for us. We have transferred our axle assembly business into a 50-50 joint venture with Foxconn. Despite the current downturn in the automotive market, the company benefits from attractive growth due to a strong order intake from top manufacturers and the ongoing trend towards outsourcing. Therefore, ZF Foxconn Chassis Modules expects to double its revenue from the current 4 billion euros to 8 billion euros by 2029, contrary to the trend. In the area of vehicle software, we've also chosen the path of partnership, and it has already been very successful. Our development cooperation with KPIT Technologies, that was established in 2021, has been transformed into the independent software company Corix. This aims to promote the development and marketing of middleware stacks that are unique in the industry. Vehicle manufacturers can thus better manage the ever-growing software complexity. This joint venture is viewed so positively by the market that the US semiconductor manufacturer Qualcomm has now joined as a partner. You can see that the realignment of ZF is progressing. In my outlook, I will explain more about our target picture and the structural and cultural measures. But first, let's look at the key figures for 2024. The ZF Group achieved sales of 41.4 billion euros. This is approximately 5 billion euros less than in 2023, but we have to take an extraordinary item of 2.6 billion euros into account. On the 30th of April 2024, the chassis systems and modules product line was transferred to the joint venture ZF Foxconn chassis modules. Adjusted for M&A effects and foreign exchange rate effects, sales decreased organically by around 3%. Adjusted EBIT came to 1.5 billion euros, which corresponds to an adjusted EBIT margin of 3.6%. Adjusted free cash flow amounted to around 300 million euros. Despite the challenging situation, we spent 3.6 billion euros on research and development. This figure equals the level of the previous year, just like the investments in property, plant and equipment of 2.3 billion euros. We are continuing our investments in the future because technical development is proceeding despite the weak market situation. At the end of the year, ZF employed approximately 161,600 people worldwide. This is around 4% less than at the end of 2023 and reflects the adjustments to the changed market situation. My colleague Michael Frick will now explain the key financial figures to you in more detail.
Vielen Dank, meine Damen und Herren, auch von
Thank you very much. Ladies and gentlemen, I would also like to welcome you warmly to the ZF Annual Press Conference 2025. I will guide you through our key financial figures and explain the most important developments. Let me start with the sales development. The market slowdown, which we had already seen in the first half of the year, intensified in the second half of the year. The production of passenger cars and commercial vehicles lighter than 6 tons fell by about 1% compared to 2023. Declining quantities in Europe and North America were partly offset by strong growth in India and China, driven by exports and incentives. The last months of 2024 were characterized by a slower ramp-up of battery electric vehicles, a changed drive mix, and adjusted strategic orientations of the OEMs. The production of commercial vehicles over 6 tons declined worldwide by about 5% due to a cyclical market downturn, which was mainly attributable to Europe. Demand has returned to normal levels after higher catch-up effects in 2023. Declining freight rates are affecting European demand. Additionally, the Chinese markets were characterized by weaker domestic demand and declining exports and developed less dynamically. Overall, compared to 2023, group sales fell by about 5.3 billion euros or 11.3% to 41.4 billion euros. This is within the communicated forecast range of 40 to 42 billion euros. The negative foreign exchange rate effect of 1.4 percentage points was mainly due to the Argentine peso, the Turkish lira, the Chinese renminbi, and the Brazilian real, whereas the Polish zloty showed opposing positive effects. Adjusted for exchange rate effects and M&A effects, which mainly resulted from the conclusion of the joint venture ZF chassis modules with Foxconn, group sales decreased organically by around 1.3 billion euros or 2.8%. Let's take a closer look at the regional distribution of sales. The largest region was EMEA, which accounted for 47% of sales. Regional sales were burdened by the difficult market environment for heavy commercial vehicles, where production fell by around 22% compared to the previous year. with normalization effects occurring after the record year of 2023. Furthermore, the production of passenger cars and light commercial vehicles in the region fell by around 5%. Backlogs are no longer a supporting factor, and the order situation is weakening. With an organic sales decline of around 4%, which was mainly due to the development of the commercial vehicle solutions and electrified powertrain technology divisions, we clearly exceeded the market development in the region. In North America, the production of passenger cars and commercial vehicles under 6 tons fell about 1%. At the same time, the production of heavy commercial vehicles stagnated. ZF's organic sales decline of around 6% was influenced by delayed model launches and the varying willingness of OEMs to offer price reductions, which led to lower acceptance among end customers. In addition, high financing costs had an impact on the consumer's choice of vehicle segment. Sales in the Asia-Pacific region amounted to 9.5 billion euros. Production of heavy commercial vehicles in the region fell by around 1%. In 2023, the catch-up effects after the end of the pandemic were a driver of production. Compared to the previous year, the market lost momentum due to weak domestic demand. The production of light vehicles stagnated. Organic sales development in the region was flat and thus above the overall market development. In South America, the decline in heavy commercial vehicle production in the previous year had still been influenced by the one-off effect of the Euro 6 introduction. Compared to the previous year, production increased by 21%. At the same time, the production of passenger cars and light commercial vehicles grew by 2%. ZF's organic sales growth was 22%, and with this, significantly above the market development. Now let's take a look at our R&D and investment activities. As you can see here, our R&D expenditure was around 14 million euros higher than in the previous year. However, the R&D ratio increased by 1 percentage point due to the decline in sales. We have increased our R&D expenditure in the field of electric mobility, especially in our electrified powertrain technology and commercial vehicle solutions divisions. In addition, we've increased spending in vehicle motion control, which is strongly represented in the commercial vehicle solutions division, as well as in our newly merged chassis solutions division. Due to a change in our ADAS business model logics, we reallocated resources and reduced research and development in autonomous driving and advanced driver assistance systems. Investments in property, plant and equipment amounted to around 2.3 billion euros, which is an increase of 1% compared to 2023. A major part of this increase was attributable to expansion investments in electric mobility and hybrid projects, commercial vehicle solutions, and passive safety systems. The increase in investments in property, plant and equipment mainly focused on the Asia-Pacific and India regions. Let's now look at the delivery of results and cash generation, starting with adjusted EBIT. In 2024, adjusted EBIT amounted to 1.5 billion euros, which corresponds to a margin of 3.6% and is within the communicated forecast range of 3.0 to 4.0%. Compared to the previous year, the result decreased by 863 million euros or 1.5 percentage points, which is mainly due to the strong downturn in the market environment, which was reflected in volume-related margin losses. In addition, high wage cost inflation and fixed costs from production ramp-ups and the introduction of new products put pressure on our margin. The weak ramp-up of battery electric vehicles led to lower capacity utilization and also impacted the gross margin. The startup of our performance programs showed the first positive effects in 2024. Higher contributions are expected for 2025 and beyond. Also, our efforts to adapt the footprint and our capacities are starting to have an impact. The reported figures already show a reduction in the number of employees. The adjustments are made with good judgment and will further improve our cost structures. We will now look at the bridge between adjusted EBIT and the net loss for the year. The adjusted EBIT of 1.5 billion euros reflects operational performance. As a reminder, we adjust our EBIT for one-off items to ensure consistent consideration of operational performance across multiple business periods and for better comparability with our competitors. The total adjustment in the amount of around 1.3 billion euros essentially include net effects from the purchase price allocation of 663 million euros, restructuring costs of 626 million euros, and in total negative effects from M&A activities and other transactions in the amount of 6 million euros. These M&A effects were largely attributable to inflows from the conclusion of the joint venture with Foxconn and the costs of ongoing M&A projects. The provision for restructuring costs relates to the allocation of expenses for our efforts to adjust our footprint and capacities. This program is an important part of the strategic realignment and a central lever for future margin development. Our reported EBIT amounted to 209 million euros or 0.5% of sales. After deducting financing costs and taxes, our net loss for the year amounted to 1.02 billion euros or 2.5% of sales. Let's now take a look at the development of adjusted free cash flow. In 2024, ZF generated an adjusted free cash flow of 305 million euros, significantly exceeding the communicated forecast expectation of more than 100 million euros. This key figure includes M&A and carve-out activities, but also deposits and withdrawals in securities and deposits to ensure comparability across several periods. The main effects which led to a reduction of around 1.1 billion euros were the market-driven decline in sales and declines in margins. This development is also reflected in operational cash generation. While our cash flow from investing activities was still burdened by high investments in future technologies, the impacts on margin led to additional pressure on cash flow. Nevertheless, our active working capital management had an effect, and compared to 2023, cash flow generation from working capital development improved. Here we see the development of our net debt and our debt-equity ratio. On the 31st of December 2024, our net debt amounted to 10.5 billion euros, which is an increase of around 485 million euros. The increase in net debt compared to 2023 was mainly due to the reduction in cash flow related to the market-driven margin losses. This more than compensated for the positive effects from the sale of 50% of the shares of our axle system assembly business to Foxconn and the sale of 11.8% of the shares in the company ZF Commercial Vehicle Control Systems India Ltd. The effects of the severe market downturn were already visible early on in our forecasts. For this reason, we proactively approached our banking group and initiated discussions about renegotiating the financial covenant. We agreed on a newly set covenant of 4.0 starting from the fourth quarter of 2024 for 5 quarters and received 100% approval from the banking group. After this period, the limit will decrease by 0.25 per quarter, returning to the level of 3.25 from the first quarter of 2026. Through our strategic financing activities, we were able to further improve our liquidity headroom as of the 31st of December 2024 to approximately 8.1 billion euros. This includes our liquid assets and the undrawn revolving credit facility. Let's now take a look at our balance sheet. In 2024, our assets increased from 39.2 to 39.3 billion euros. This is primarily due to an increase in financial investments. On the liabilities side of the balance sheet, pension provisions declined as a result of higher interest rates, in particular due to interest rate increases in Germany. Additionally, long-term financial liabilities increased because of new financing. Our equity development was positively influenced by effects from interest rate changes and foreign exchange rate effects, particularly from the US dollar and the Chinese renminbi. Additionally, the sale of 11.8% of shares in the ZF Commercial Vehicle Control System India had a positive effect. However, the market-driven performance overcompensated for these effects, leading to a slight decrease in the equity ratio. Taking into account the balance sheet extension, our equity ratio then stood at 19.2%. Thank you for your attention. I will gladly answer any questions you have later and will now hand the floor back to Holger Klein.
Vielen Dank für die Erläuterung, Michael.
Thank you for your explanations, Michael. Ladies and gentlemen, at the beginning of my outlook on our strategic development, I would like to present our forecast for the full year 2025. The outlook remains cautious and conservative. The forecast continues to be characterized by a weak economic environment with declining orders, geopolitical conflicts, and protectionist measures, the consequences of which will only gradually become apparent. A sweeping recovery in the passenger car markets is not foreseeable. With stable foreign exchange rates, we expect group sales of more than 40 billion euros for 2025. We do not expect a significant change in the sales figure compared to the previous year. Assuming a corresponding market development, and if supported by further improvement in cost structures, we expect an adjusted EBIT margin between 3 and 4%. In terms of free cash flow adjusted for company transactions, we expect a value of more than 500 million euros. I have already explained to you how we want to achieve our new target picture. Let's now take a look at this target picture. We're going to start with our core areas. Strengthening our strengths means continuing to grow in those market segments where we are already one of the top 3 global players. We are therefore continuing to invest in the areas of chassis, commercial vehicle, and industrial technology, as well as the aftermarket business. For these divisions, we took far-reaching development and investment decisions in 2024 and developed growth potential. In these segments, we will grow faster than the respective markets. We have achieved initial success with this realignment. We founded the Chassis Solutions divisions and merged 2 previously independent units. The Passive Safety Systems division is now ZF LifeTech and operates independently and successfully on the market. We have transferred our axle systems assembly business into a joint venture with Foxconn. And we decided to end the further development of autonomous shuttles, which was also part of setting the strategic course. In electric mobility, as well as electronics and advanced driver assistance systems, we are striving for partnerships to strengthen them for the future and release growth potential. In this way, we want to align these divisions even closer with our customers and the market, and create an ecosystem for the mobility of tomorrow. I will now briefly address the individual areas. In January 2024, we founded the Chassis Solutions division. For this purpose, we have merged the active safety systems and car chassis technology divisions into one unit. This is how we leverage the full potential in the chassis business and continue to act as an innovation leader. This applies above all to the well-demanded by-wire technologies, where brakes or steering are controlled purely electronically. This also includes intelligent chassis solutions for the software-defined vehicle. The fact that our chassis strategy is promising is demonstrated by the major order from a leading US manufacturer for its brake-by-wire braking system, which will be used in almost 5 million vehicles. We are equipping the flagship electric vehicle ET9 from Chinese manufacturer NIO with a steer-by-wire steering system, the first volume production vehicle in China with steer-by-wire technology that received state approval for mass production. In summary, we are the world's leading provider of vehicle motion control. We are the only company that offers a complete portfolio for longitudinal, lateral, and vertical dynamics in hardware and software. Our Commercial Vehicle Solutions division has a strong market position. With the widest range of products and solutions on the market, we are the most successful global supplier of commercial vehicle technologies. We have further expanded this leading position through targeted investments. We are relying strongly on a platform approach, which means we develop products once and then adapt them to different applications. This makes us particularly fast, and our customers benefit from a technological edge. These products also convince our truck and bus customers. At the IAA Commercial Vehicles last year, we were able to win a lot of new business with powertrain and braking systems. We are focusing in particular on the tractor truck and trailers. Our trail track system, with which we electrify semi-trailers, is attracting growing customer interest. Our Industrial Technology division is among the top 3 worldwide. With a global market share of 25%, we are a leading manufacturer of wind turbine gearboxes. In 2024, we celebrated an anniversary that is closely linked to ZF's adaptability and innovation capabilities. As early as 1924, ZF adapted a passenger car transmission for use in rail vehicles, laying the foundation for our rail drives business unit. The business unit still benefits from these synergies today. In addition to drives, we offer our customers digital products. They help to detect damage to the powertrain and tracks early and enable efficient maintenance. The ZF Aftermarket division developed very positively in 2024. It benefited in particular from lower new vehicle business and higher service requirements. Digital diagnostic and service offers are also becoming increasingly important in this field. The division grew organically by around 12% to 3.6 billion euros, the strongest growth among the ZF divisions. ZF Aftermarket is also a driver of sustainability. With our remanufacturing solutions, we extend the life cycle of components and reduce the demand for new products, which contributes significantly to the circular economy. Now let's talk about the potential that we aim to unlock further. These are the divisions that are currently not yet leading their market. One example is our division for electrified powertrain technology. Here we have profound expertise and excellent technology for conventional, plug-in hybrid, and purely electric drives. Many see this division as the heart of ZF. This expertise is something we will also need in the future, for instance, in commercial vehicle and industrial technology. Unfortunately, electric mobility is advancing much more slowly than expected. The competition is fierce, the pace is fast, and there's room for improvement in terms of the margins. Investments are needed to grow and achieve the necessary economies of scale. Currently, we're checking which path leads best to a successful future. Initially, this involves partnerships. There are no decisions yet, but we're preparing the powertrain division to become independent enough for a partner to get involved. We understand that these considerations evoke emotions among the people working in the electrified powertrain technology division. Therefore, it's important to us, a potential partner should win our heart, not tear it out. The division should be at the forefront of the competition. To achieve this, we are in ongoing dialogue with all stakeholders. We also see potential in our electronics and ADAS division. We are a market leader in camera-based ADAS systems. This area has developed well and is profitable. Here too, we are exploring opportunities for further growth with partners. The reason is our observation that driver assistance systems and infotainment systems are merging. Vehicle manufacturers want a one-stop solution. Significant investments are needed to develop this technology, which we currently cannot manage alone, so we're considering partnerships. We aim to transform the large tanker ZF into a strong fleet of agile speedboats. Strong divisions that are already among the top 3 will form the core of the company, where we will continue to invest independently and where we are successful. Our divisions, with synergies to the core business and top 3 potential, will be further developed together with partners. It is important that they remain part of the ZF fleet and that we benefit from their technology and revenues. Finally, there are areas that we will operate with partners or sell to partners to reduce our debt and enable them to grow more. You see, we are addressing the challenges with a clear strategic action plan. Its goal is to reduce ZF's debt and develop it into a more agile and profitable technology leader. Ladies and gentlemen, we are not there yet. 2024 and 2025 are years of transition. However, the future outlines of ZF are becoming increasingly clear. In 2024, we've already achieved a lot. We continued on the path of transformation and achieved significant improvements through performance programs. We're confident that we will continue to be among the most successful Tier 1 suppliers in the future. Thank you for your attention. I'm looking forward to your questions.